What's going on, everybody? So in our last video, we were talking about how investors were totally missing this huge thing brewing in the markets, like something big was about to drop and nobody was paying attention. So let's dive into last week's craziness. We got the Moody downgrades, Trump's tariffs on EU and Apple, and those treasury yields creeping up. It's a lot, right? So let's break it down and see what's driving the markets wild. First off, stocks took a bit of a beating. Big names like Apple and Nvidia, yeah, they got hit hard, and growth stocks were straight up struggling out there as well. Now here's the big thing. The S&P 500 slid 2.61%, which isn't fun, but small caps, oh man, they tanked 3.47%. But don't worry, we're gonna pull up some charts later to dig into those moves. That brings us to the sectors. Energy was the big loser, down 4%. Meanwhile, staples held it together, only dropping less than 1%. Tech, though, was the second worst performer, which makes sense with those heavy hitters like Apple dragging it down. So you might be wondering, what's got the market so rattled? Is it the tariffs or those rising yields? Let's zoom in on yields for a second. So with that said, rising yields are a big deal. When they go up, borrowing gets more expensive and growth stocks like tech feel the squeeze. Investors start eyeing bonds over stocks, and that's when things get shaky. On top of that, tariffs could mess with companies like Apple, hiking costs and squeezing margins. Not exactly a party. So what's the vibe going forward? Are we just gonna see some jitters, or is this a bigger shift? Stick around, because we're gonna dive into those charts and figure out what's next. Alright everybody, let's kick things off with the US budget. Now check out this chart here. It shows the budget balance as a percentage of GDP from 1954 all the way till 2024. You can see in these blue spots here, those are the surpluses, and they're super rare, as you can see. We had a few in the late 90s and early 2000s, but since then it's all been deficits shown in the black here. So by 2024, we're about minus 5% of GDP. So yeah, the government's been spending more than it's bringing in for a very long time. Now here's the thing, how does that affect the overall debt picture? Let's take a look at this debt as a percentage of GDP compared to the 10-year treasury going back to 90s, 80s. The blue line, that's the debt to GDP. It's been climbing like crazy here ever since 2008, hitting at around 120% by 2024. Meanwhile, the yellow line, which is the 10-year yield, peaked at around 10% in the 80s, but has mostly gone down, sitting at around 4% in 2024. So even though the debt has been piling up, yields have been stayed pretty low until recently, that is. So you might be wondering, does all this debt cause any problems? Well, that brings us to the next chart. Now let's talk about what happens when that debt gets too big. This chart shows the S&P 500 alongside major US debt downgrades. Back in 2011, S&P dropped the US to AA+, and the S&P took a little dip but bounced back fast. In 23, Fitch did the same from AAA to AA+, and the market just kept climbing. But check this out, in 2025, Moody's downgraded us from AAA to AA1, and the S&P took a pretty sharp hit. So why the bigger reaction this time? Maybe it's because of all the debt that we just saw piling up. So with that said, what does this all mean for the future of the budget? Let's check out the next chart. So here's where things get even messier. This chart from the CBO shows that a recent tax bill is going to add nearly $3 trillion to the federal deficit over the next decade. That's right, starting at $113 billion in 2025, it balloons to $597 billion by 2028. So the government's gonna have to borrow even more to cover that gap, which could mean more pressure on those yields we just saw earlier. And you know what that leads to? Higher borrowing costs. Let's see how that's gonna play out next. Okay, so this chart shows federal interest expenses as a share of GDP, and it's been spiking hard. Now by 2024, we're nearing that 3% of GDP, a level we haven't seen since the early 80s. So back in the day, we hit these highs during big economic stress, like the ones in the 40s, 80s. So with all that debt and borrowing we've been talking about, it's no surprise the cost of paying it off, is getting out of hand here. So since yields play a big role in those costs, let's zoom in on what's happening with treasury yields next. So here we got the 10-year and the 30-year treasury yields from 2023 to May 2025. The yellow line, that's the 30-year. It spiked to nearly 5% in 2023, and it stayed pretty high, around 4.8%. The blue line, the 10-year, hit 4.9%, but back then it has settled into a range between 4.3% and 4.5%. So the longer-term yields are feeling some serious pressure because probably of those debt concerns. But the 10-year is holding steady for now. So you might be wondering, how do rising yields affect the stock market? So this shows how the S&P 500 reacts to changes in 10-year treasury yields. When rates drop a lot, like the z-score below -2, the S&P tends to gain about 1% in nominal terms, but it actually loses 3% in real terms. But when rates rise sharply, like a z-score above 2, the S&P drops about 1% nominally and 3% in real terms. Right now, in May 2025, yields are up by 60 basis points. So we're in that rates rising zone, meaning stocks might be facing some headwinds. And speaking of headwinds, let's see how much uncertainty there is with the next one. So here we have the Economic Policy Uncertainty Index with the VIX, which measures market volatility from 2015 to 2025. You can see both spiked in 2020 during the pandemic, and they're spiking again in 2025. Policy uncertainty is around 500 and the VIX hit 80. That's probably because of the debt downgrade and all the fiscal drama we've been talking about. Even though they're off their peaks now, there's still a lot of uncertainty and volatility out there. So with that said, how are then economists feeling about inflation in this uncertain environment? Let's take a look at that. Alright, so here's what economists are thinking about inflation in 25. Based on Bloomberg surveys, back in April, they were expecting core inflation to hit around 3.2%, with some even predicting 4%, but by May 2025, they've lowered that to about 2.5%. So it looks like inflationary pressures might be cooling off a bit, which could take some pressure off those yields and maybe even influence what the Fed does next. But here's the thing, are there other signs the economy might be slowing down? Let's check it out next. So this chart compares economic data trends after big events, like in past recessions versus now. On the left, you see past recessions. Everything from soft data, like surveys, to hard data, like GDP, tanked within 80 days. On the right, in early 2025, soft data, think expectations and surveys, has dropped a lot, but hard data is holding up better. So we're seeing some early signs of a slowdown, but we're not in a full recession territory yet. So you might be thinking or wondering, what do the markets think about a recession? So this chart uses market indicators to guess the chance of a recession in the next 12 months. The highest risk comes from the 12 months forward change in the federal funds rate. It's at 39%. Other indicators, like the VIX at 3% and high yield spreads at 0%, are way lower. So on average, the risk is about 17%. So the markets are saying there's a moderate chance of a recession, but it's not a sure thing yet. Just something to keep an eye on. Now, how are companies feeling in this environment? So here we got a comparison of how many S&P 500 companies gave annual EPS guidance in Q1 2025 versus Q1 2020 during the COVID crisis. Back in 2020, only 100 companies gave guidance, and 185 actually pulled theirs because of all the uncertainty. Now, fast forward to Q1 2025, and 251 companies are given guidance, with just 8 pulling back. So companies seem way more confident now than they were during the pandemic, even with those recession risks we just saw. But here's the thing, what are their actual earnings projections looking like? This chart shows the S&P 500 earnings per share projections from December 2024 to April 2025. The blue line, that's the forward 12 months EPS, and it's been climbing, sitting around 275. The red line, which is the full year 2025 EPS, dipped a bit to around 265. So short-term expectations are looking pretty solid, but there is a little cautiousness for the whole year of 2025, maybe because of that economic uncertainty we've been talking about. So with that said, how's the market pricing in all this economic stuff? So here's a look at how the market is pricing economic growth, comparing cyclical versus defensive stocks alongside GDP growth forecasts from 23 to December 24. When GDP growth forecasts were strong, like 2.5% in mid-24, cyclicals did great. But by December 24, 2024, GDP forecasts dropped to 1.5% and cyclicals started lagging. So the market is clearly pricing in slower growth, which lines up with those economic warning signs we saw earlier. So let's zoom in on what's been happening more recently with sectors in early 25. Alright, these two charts give us a closer look at early 2025. On the left, from February to April, 10-year yields went up and recession probabilities actually went down, so the market wasn't too worried. But in May 2025, those probabilities ticked up a bit, even though yields stayed steady. And on the right, you can see defensive stocks starting outperforming cyclicals in May, even with resilient economic data and rising yields. So investors are getting a little bit cautious, probably because of that slower growth we just saw. Now, how's the S&P 500 been doing with all this going on? Now, check out this chart. It shows the S&P 500's 1-month trailing returns and what happens afterward. On May 13, 2025, the S&P 500 was up 18.1% in the past month, one of the biggest gains on this list. Historically, big gains like that have mixed results. In 2020, a 28.7% gain led to a 54.48% return over the next year. That's amazing. But in 2002, a 15.6% gain was followed by a 9.81% drop in just a month. So the S&P 500 has been on a tear lately, but history says we might see a pullback. So you might be wondering, how are investors feeling after a rally like that? So this chart shows the AAII bull-bear spread, which tells us how optimistic or pessimistic investors are. It's been all over the place from 21 to early 2025, dipping into negative territory when people got scared. As of April 2025, it's at zero, meaning investors are totally split, half bullish, half bearish. So there's a lot of uncertainty out there, which makes sense with everything we've been talking about. But here's the thing, let's see if the broader market sentiment matches that with the Fear and Greed Index. So the Fear and Greed Index, updated on May 23rd, 2025, is sitting at 64. That's in the greed zone on a scale from 0 to 100. That means the market as a whole is leaning toward optimism, with investors willing to take more risks. But wait, didn't we just see investors were split? This greed might be a sign of overconfidence, especially after that big S&P 500 rally we talked about. And you know what happens when there's too much greed, right? Let's see if the market is getting overbought. Alright, this chart shows the percentage of Nasdaq 100 stocks with an RSI above 70. That's a sign they're overbought in the short term. Over the past few years, whenever this percentage spikes, the Nasdaq 100 often pulls back, like in 2023 and 2024. So right now, in May 2025, we're nearing 40%, which is pretty high. So with all that greed we just saw, the market might be due for a breather soon. But here's the big question. Are these high prices even justified? Let's wrap up with valuations. So our last chart looks at valuations for the S&P 500, focusing on the Mag 7, those big names everyone talks about. This scatter plot compares actual PE ratios to what they should be based on fundamentals. The S&P 500 median is around 15 times, but the Mag 7 are about 25 times, which is actually a bit below their modeled failed value at 30 times. So even with the rally and overbought signals, these big players aren't crazy overvalued, which is a bit reassuring. And there you have it, folks. We've gone through the whole story, from massive deficits and rising debt to economic warning signs, market rallies, and some serious overbought signals. While valuations look okay for the big guys, there's a lot to be cautious about as we move through 2025. So what do you think? Are we heading for a correction, or can this rally keep going? Drop your thoughts in the comments. Now that we've covered macro charts, let's dive into some key TradingView charts to get the latest insights on where the markets are right now. And here we have the S&P 500 SPY on a weekly chart. It looks as if we have found some resistance here at the Fib 0.854. And if we switch to a daily chart, it looks to us that we have completed a small, I would say 1, 2, 3, 4, 5 of an Elliott wave degree, which could set the stage for another cycle upward. So the question is, where do we find support? Now, if we take a look at some of the moving averages here, the good thing here is this bullish crossover here. And that means that the 55 is above the 233. And right now it looks as if the SPY wants to test the 21 EMA. There's also an open gap here that could get filled. So it looks as if the 55 is approaching that gap and price. So these are the key moving averages that we want to watch. If for some reason we would start breaking down below these moving averages, well, then we can get very critical. So the last value area lows here is at around 520 levels. So that would suggest that the SPY could even retest and close this lower gap here. But for now, we can see here the volume profile is telling us that the sellers are in control, and we're likely going to perhaps find support within these moving averages. Just watch if we're getting a break below the 233. Now, if we glance a little bit at the Russell 2000, we would have hoped already that we would have closed above or broken out from this trend line, but this trend line has acted as resistance for now. And let's zoom into the daily, and we can see here that the 233 EMA has acted as resistance, and we're now currently below all key moving averages, meaning could the Russell 2000 be a leading indicator to what the SPY might go? So we're watching the Russell 2000 here very carefully. And since we're below all key MAs, the last nail in the sand here would be this value area low. And we're going to watch on Tuesday if we're going to start finding some bid at this level. If not, we're going to likely retest and perhaps close this gap here. And obviously, I'm a Fib fan, so I look at the Fibonacci levels here. So watch this level here on Russell 2000. We're looking at the precise 200 level here. We want to stay above that level and break above these key moving averages. Also, if we're getting a breakout here from this lower high trend line, that would suggest that we are in a bullish phase. So this is a key level to watch here. The same thing goes with the QQQs. They resemble pretty much everything that we've talked about with SPY. Now, let's take a look at the MOVE index here, which measures bond volatility. And we've had a massive drawdown here on the MOVE index, which has translated to higher prices overall in the crypto markets, in the major indices, and this is exactly what we've seen. So this is a potential leading impulse here of 1, 2, 3, 4, 5, and that is why we had this massive drawdown here. So when we look at the MOVE index, it's basically just to see if there's stress in the bond market. And since we're within this normal range here, there's nothing to panic about. So this is a range that we want to be inside, and we're just gauging right now if the MOVE index could perhaps start waking up from these levels. If that's the case, then we do want to be a little bit cautious here. So since we are within that green box, there's nothing really to worry about. Let's also take a look at the 10-year treasury yields, and we can see here we're tracking the futures market, and we can see here that the value area or the volume profile here, the POC line has turned into a bearish mood here. So we can see here that perhaps it looks as if we have completed a 5 ways here. So we could see a correction. If we broke below this 8 EMA, so we're going to see here if we're going to find support here within these 3 moving averages coming next to 21.55 and 233. If yields start to drop here, that would be a very good sign for the markets. And ever since this drop here that started here in January, mid-January, we look at this as a potential impulse here. So this upside move recently has just been corrected. So we're looking for yields to drop, and we're going to also glance and take a look at the US dollar as well. And we would have thought that the dollar could perhaps find a bid here, since we've had a potential conclusion here of this 1, 2, 3, 4, 5 impulse, meaning after a 5 impulse we do get a correction, and seems like the dollar's found some resistance here again at the 55. Although we would have thought that the correction would likely be a little bit higher than this level. So we're watching here if the dollar will catch a bid here, but since we're below this POC line now, it looks a little bit bearish. Although this downside move here, one could make the case that it's impulsive, so one could perhaps maybe take a look at this and maybe it would materialize in this way or the other. So we're watching the dollar here very carefully. We want to break above this POC line here, and if we're above that POC line again, that would have been translated into a failed breakdown, and we're likely then going to see the dollar catch a bid from these levels. Everybody's been so bearish on the dollar recently, and that is why from a contrarian standpoint, we think the dollar could catch a bid here, but I don't believe that we're going to find ourselves in a very, very strong upside cycle here for the dollar, and I'm going to explain it very shortly. But we're looking for perhaps a correction here, maybe retesting the 233, which would be logical, or we could even go as high as 105 here at the 0.61 0.618 before resuming lower. Why would we resume lower? Well, if we take a look at the dollar here on a monthly chart, we believe that the cycle here, let's bring this one to position. So we look at this as a 5 waves move here. Okay, and we believe that this cycle has concluded, and right now we are just correcting. So we have been finding ourselves in an B wave here, and right now we are in wave C. So wave C should perhaps take us down to this 0.618 level. We're looking, after all, for a break of trend here that would confirm that this upside cycle we've had since 28 and began more rapidly here in 2011 would conclude. So that would set the stage then for the dollar perhaps to begin a new upside cycle. So we're looking at this 0.618 here, but obviously for this to materialize, wave C is always impulsive. So it would have to do something along the line of this, right? So we're looking for a 1, 2, 3, 4, 5, and that is why I talked about earlier on the daily chart that we could see a correction towards the upside before resuming lower. So that's just from a trade standpoint. If you like to trade or do some short-term trades with leverage, you can take advantage of situations like that. So we're watching the dollar there, and we're also now taking a look at the commodities markets here. We're looking at silver, which has been acting very, very interesting here. What I like about silver is that we are above that value area high here. So this is acting as support for the long term. We're looking at a monthly chart. Now let's take a look at silver here on a daily, and it looks like this trend line here could be held and that we are seeing a break of trend here. So let's see if this trend line here is going to hold, and that could obviously take us to higher silver prices moving forward. So these are the key moving averages that we want to see silver retain, and obviously above this trend line here, and that could take us to a new high. So if you're a trader, you might want to take a look at silver futures here. So that would be a breakout again from this previous high here. Let's also take a look at gold. And I want to quickly emphasize that gold here has been in a massive bull market, and we believe that right now gold has concluded what we think is a intermediate degree 1, 2, 3, 4, 5. Now we would have thought, we explained this earlier in a previous video, and I've talked about this on X, is that we believe that gold could see some more selling here before resuming higher. And that the reason why I believe that is because once you conclude a wave 5 of intermediate degree, you want to see a more correction in order to initiate a new primary degree. So as you can see here, gold have respected this 55 EMA for a very long time. Now that's a very good thing, obviously, but the more you test a moving average, the weaker it gets over time. So we're looking for gold here to perhaps start breaking down here. We can see here right now, we're looking at gold futures. It's breaking down from this 0.618 level. So we could potentially look at this as a potential A here, and then a corrective wave B, and then we could perhaps see some further selling here. We're looking at this 233 EMA for potential support. Obviously, we could also see gold start to break down here to these 2,500 levels. We could also see gold retest the value area high here, but we would get more confirmation once this low here has been breached towards the downside. So we're looking for gold to continue downward here. Obviously, we could be wrong, but we think that this wave 5 intermediate degree will set the stage later for a new primary degree. So that would be a massive buying opportunity. Let's also take a look at the USDT to dominance ratio. So we're looking at USDT dominance versus total dominant of the entire crypto markets. Now we have been a little bit bearish here on Bitcoin recently, up until the breakout that we highlighted on X. We saw Ethereum breaking out, and we were pretty early to that trade there. So we are looking at the USDT here, and the reason why we're doing it, because it tells us basically which one is in dominance. So you have to understand that when you buy cryptos, right, when you buy Bitcoin, you're actually selling USDT, right? Let's just say you hold USDT, you're selling USDT in order to buy Bitcoin, right? So past bull markets, we can see here when Bitcoin rises, you have USDT dominance declining. Why? Because people are selling USDT in exchange for Bitcoin. We also saw this decline here during the bear market and then set the stage here. And that means that when people were selling Bitcoin, they were buying USDT basically. So that's a indicative sign of a bear market. Now, if you take a look at this recent move here since FTX broke down in 2022, we've had a massive bull market here for Bitcoin, and at the same time, people were selling USDT in exchange for Bitcoin. So what does that mean basically? Well, it means now that USDT has the potential to rise. And would that coincide with selling with Bitcoin? Yes, absolutely. Why? Because after a bull market, people are exchanging Bitcoin for USDT. So we're looking for a potential drawdown here for BTC, and we're watching this USDT dominance. And we can see here already that we are above trend. And if we switch over here to a daily chart, this is the recent breakout here. We've actually watched this very, very carefully, and we nailed it when we started buying Bitcoin very early, as well as Fartcoin breaking out in February already. And now we're looking for USDT to start catching a bit. So we can see here, this is a classic correction here for USDT, and we're looking for a break of trend here very soon to happen. And that could obviously put some selling pressure on BTC. So we're watching this carefully. The VIX here also, we highlighted this on X. We nailed this one that the VIX would find support here at the 100% extension. Why? We look at this as an A, B, and the 100% extension typically ends wave C, and that's where VIX found support. So we have seen VIX here starting to wake up. We're above that 8 EMA again. We're looking at this 55 EMA as potential resistance, but we think that the VIX could start waking up here again. And so we're watching this carefully. We're obviously looking at VIX futures here so we can get access to volume. And the volume is telling us that there's a lot of support at this level here. And we're obviously open to the idea that this POC line could get retested before resuming higher. So obviously we think that this is the bottom here for the VIX, so we're watching out a little bit for potential more volatility in the market. So that's how the indices and the overall market is looking at. We can also take a look at Bitcoin here. We have been a buyer here ever since the breakout. We also highlighted this very carefully for Ethereum as well, right? So we had this classic ABC pattern here. Everybody hated Ethereum at this level, and we knew back then that we were just going to buy this thing. Here's some little bit of worry here. We are below that. We've just retested this POC line, so this could act as resistance, although we don't believe that we're going to see selling yet for Ethereum, because if we take a look at this impulse here recently, maybe we could switch over to a daily chart. So here we have a potential 1, 2, 3, 4, and we're looking for a further rise here for Ethereum to conclude a potential leading diagonal, or an ending diagonal for that matter, and then we could start seeing some selling here. So what's going to be happening next is if we can stay above the 233, we also want to see this 55 starting crossing above that 233 level. That would be very, very bullish for Ethereum. The only thing that I kind of feel a little bit worried about, I am not a fan of these fair value gaps here. These candles are nothing that I want to see other than just taking advantage of them. But you can see here, every time we do produce candles like this, I mean, the market kind of loves to fill them at a later stage. You see it right here. I mean, these candles are classic just pumps for them to just get dumped, right? That's one way to look at it. We're looking for more upside here for Ethereum for potential resistance later. And obviously I'm an Elliottician, so I look at things at wave and I take advantage of markets both sides. So we like to short and we like to go long when the timing and the price action is telling us that. That's how we're looking at the markets right now. We are waiting to see what the Russell 2000 is going to do. We're waiting to see what the VIX is going to do here. And if the dollar starts catching a bid, you want to be a little bit cautious here. I believe we're also in the last stages here. We looked at Ethereum that we are in that wave 5, so we can see some distribution here. And if there's any selling, in my opinion, you should take profits when markets racked up a lot, and then find an area of support and try to manage risk and try to enter again, or take advantage by shorting. So the SPY, you want to take a look at these moving averages here again. Look at the VIX, look at the MOVE index and the dollar especially. So that was it for today's video. I hope you liked the charts. Thank you so much for watching again. You can follow me on X, subscribe if you haven't already, and I'll see you guys in the next one. Take care for now.